Good afternoon, everyone. My name is Regina Beatty, and I'm a financial planner in the Pittsburgh and Sarasota Heritage's offices. Thank you for joining us for the third session of the Heritage Speaker Series. We are thrilled to bring to you today a presentation on estate and trust law updates. Presenting on this matter will be Tom Sessa and Sherry Dorsey of Sessa and Dorsey, a law firm from the Hunt Valley, Maryland area. Their firm handles all aspects of estate planning, estate administration, trust administration, in addition to other areas of specialization, including special needs planning, business succession, etc. Their firm gets it, the need to collaborate with their client's financial planner to ensure fully coordinated solutions. So Tom, please take it from here, and I hope you all enjoy the presentation.
Thank you very much, Regina. I want to thank everyone for joining us today. Sherry and I are very pleased to present to you. What we're going to do is a question and answer session with each other where we lay out some of the key changes in the law and how they may impact your estate planning and how important your financial advisor and other key advisors are in making sure that your plan is updated and current. We've been going through a very difficult time over the last 20 years in the estate planning world, in the sense that the laws are changing fairly regularly, and planning that is effective today could very well be ineffective 2 or 3 or 4 years later when the law changes. And we are currently in a phase now where the law may change dramatically over the next year. So Sherry, I was going to turn it over to you and ask you, what is the current state of the tax law, and where is it likely going?
Thank you, Tom, and welcome to everyone. So currently, the estate tax laws are more favorable, more generous than ever before. So currently, as a U.S. citizen, you can pass $11.7 million of assets at your death free of any federal estate tax. If you go above that $11.7 million, then the federal estate tax rate is currently 40%. So as a married couple, if you do your planning properly and you elect portability of unused exemption, you really have $23.4 million of federal exemption available to your estate after you pass away. Now, the interesting part is that if you have been in practice, like Tom and I have been practicing together for quite some time, and you would not know that this $11.7 million is very, very different from what it was even just a few years ago. So to give you some idea of the history of the federal estate tax exemption, for many years it was less than $1 million, then it went to $1 million, then it was $2 million, then it was $3.5 million. And up until a few years ago, the exemption was right around $6.5 million or so, and then it was doubled. So in a very short period, overnight almost it seemed, the federal estate tax exemption doubled to $11.7 million. The interesting part is, of course, if you watch the news, if you read anything, you know that that's a large aspect of any tax proposed legislation or what's being written out there is that federal exemption would be decreased significantly and that the estate tax rate would increase. So both of those, of course, would be a negative for high net worth clients. So as an example, it could go from $11.7 million to, say, $5 million to $6 million. There's also a possibility that the estate tax rate could go at 50% or 60% even. So there's a lot of unknowns right now on what's going to happen on the federal estate tax side. In addition to the federal estate tax exemption, you have a gift tax exemption. So the gift tax exemption is the amount that you can give away during your lifetime without paying any gift tax, even though whatever you give away will use up an equal amount of your federal estate tax exemption. Now that sounds very confusing, but basically an example would be if you have $11.7 million of a federal estate tax exemption available to you, and you actually give away $10 million of assets in your lifetime, then when you pass away, you would no longer have $11.7 million, you would have $1.7 million of federal exemption remaining, okay? One part of the proposed estate tax rules actually provide that the gift tax exemption would separate itself from the federal estate tax exemption. And this has happened in the past, so it wouldn't be completely unheard of that this happened. For example, there is some idea that perhaps the gift tax exemption, the amount you can pass during your lifetime, may go as low as $1 million. So a lot of high net worth clients today are trying to gift away assets as much as they possibly can, knowing that perhaps that window of opportunity is about to close. There have been some discussions, will they pass a law that's retroactive? So some clients, and we hope that we're going to not see a change that becomes immediately effective or is retroactively effective. In a perfect situation, and what we've seen in history before is that there is usually some warning that this change is coming. So for instance, we would imagine that a change might be effective, say January 1 of 22. But so the clock is sort of ticking for a lot of high net worth clients as far as what they could try to accomplish before year end to try to reduce their taxable estate. For those of you who are Maryland residents, I'll just touch briefly on that. Tom and I are licensed in Maryland, so we really focus on Maryland residents. Maryland is in the minority where you actually have a separate state estate tax as well. So that's why Maryland is truly one of the worst places to pass away. Maryland's state estate tax exemption is $5 million per person. So as a married couple, you can pass $10 million free of Maryland estate tax if you do your elections properly. And the Maryland estate tax rate is 16% for anything over that exemption amount. So it really is a pretty difficult and uncomfortable tax for families to pay. So part of our job is to try to ameliorate those estate taxes. Now, as part of this proposed regulations that are out there, there's also been some discussion of income tax changes and basis issues. So Tom, can you tell us a little bit about that, please?
Sure. So in addition to potentially increasing estate taxes by lowering exemptions, there's also a current push to increase income taxes, both for those of us living and really upon death. I'm going to start with the first, which is what are the issues that we have in current income tax proposals. And the current proposal is to increase the rates similar to where they were prior to the 2018 tax law changes, so that in essence the top rate would increase to close to 40% again, and there would be bracket increases along the way. There's always in these proposals, there are attempts to keep some of the lower brackets low because that affects more people, but certainly the higher brackets would be affected. In addition to that, there is discussion about increasing the capital gains tax rate, which really does affect savers in a substantial way. We're going to talk about the step up in basis separately in a minute, but I did want to mention that there are proposals to increase right now the federal capital gains tax rate is 20%. There are discussions to increase it to the highest marginal income tax rate, which will almost be 40%. If that were to occur, then there would be substantial tax for assets that have grown that were purchased at a low basis and then sold at a higher basis. And that can create a real problem. Transitioning on to the post-death side, where we talk about the step-up in basis, one of the most valuable tax benefits that are out there for people is that when you own an asset that you purchased at a lower price and you die owning it, you get a step-up in cost basis to the date of death value. Importantly, this doesn't apply to traditional retirement accounts because basically they were never taxed in the first place. But any asset, for example, your home, which has some capital gains tax exemptions built in if you sell it, but your home, stocks in an after-tax account, if you have a business that you've created, any asset that you've purchased, and I'll use this as an example, if you bought Exxon stock at $30 a share and it's now worth $100 a share, if you gift that asset or you sell that asset, there's a $70 capital gain for each share, and there's currently a 20% federal capital gains tax, which could also increase if they increase the capital gains taxes. And that assumes you held it more than a year and you're looking at long-term gain. If the step-up in basis is eliminated, then upon death, your inheritors, your beneficiaries, would take your basis. Whereas currently, if you died owning that Exxon stock, the new basis for your beneficiaries would be $100 a share. So in essence, if you bought that stock for 30, died owning it, and your family sold it the next day, they would pay no capital gains tax at all. So that loss of a step up in basis, they're envisioning could create billions of dollars in additional taxes. The funny thing is their expectation is that income tax would actually go down in the near term because people would be reluctant to sell assets, hoping that the law would change. But over time, if the law remains steady, eventually assets need to be sold. There is a proposal within the proposal to provide for $1 million of step up for an individual and $2 million for a married couple. So if that is actually part of any final plan, then there still will be a valuable step up for substantial gains for many people out there. But if anyone, again, a family business or any other assets that have increased dramatically in value, losing that step up in basis will make it very difficult to pass assets without there being a very significant income tax hit at some point. Putting all of this together, I will use Maryland as an example because Maryland has an estate tax, and then I'll use it where if you're, for example, in Florida where you do not have an estate tax. If all of these tax changes occur and you have a taxable estate, an asset in Maryland could be taxed as high as 76%. Once you take into account the federal estate tax, the Maryland estate tax, as well as eventually paying capital gains taxes when the asset is later sold after death. For someone that's subject to federal estate tax but no state estate tax, that rate could still be as high as 61%. And so these proposed changes can become problematic for families that have taxable estates. And again, it's possible that estate tax exemption could be lowered to as low as $3.5 million per person. So a number of people who are not in taxable estate situations today very well could find themselves in a taxable situation, especially if you think about assets that many of our clients don't consider to be taxable assets while they're alive, but when they later pass away, those assets become taxable. And particularly I'm talking about life insurance and some other assets. So if we could advance to the next slide, I would turn it over to Sherry to talk a little bit about the assets that apply to your taxable estate, especially those that we don't always think about being part of our estates.
Yeah, so it's quite common. We start off our estate planning process with trying to determine whether the plan needs to involve estate tax planning. And so what we're really looking for then is a snapshot of the total assets, and we're sort of planning for the worst case scenario, right? We all expect we're going to live a very long lifetime, and hopefully that is the case, but our job is also to sort of plan for the unexpected for our clients. So we start off by saying, okay, snapshot of what do you own today, and of course, the normal assets that count towards your taxable estate that everyone starts with, right? So they'll say, oh, I have this investment account, I have this home with this equity in it, we have some checking and savings, and we have some retirement accounts, and they add that all up and they say that's our taxable estate. What usually takes people by a big surprise is the fact that life insurance, although we don't really think of it as an asset of ours, counts towards your taxable estate. So as an example, clients, typically when you have young children, you might go out and each husband and wife purchase $1 million term policies. Well, for that 20-year term, husband and wife have a taxable estate of at least $2 million because of that. And so that's, usually catches people by surprise. Then when you add in retirement accounts and equity in homes, et cetera, clients all of a sudden realize that they are in a situation where they may need to be doing some estate tax planning. The saying that we always like to use is that you prefer to work with clients who have time on their side. And what I mean by that is if you start planning earlier, then you have time to use some techniques, take advantage of some opportunities. There are some times when there are unaccounted windfalls. People who might not be expecting, but they should think about the fact, what's your estate going to look like if you have an inheritance? What can you sort of expect in that route, and what kind of estate tax situation does that put you in? When we do estate planning, we do find that we have to build in, some of the flexibility because of that. So although the tax law changes may change, don't let that be a reason to not do any estate planning at all, because the fact of the matter is we can still set up a plan for you that is going to maximize the estate tax exemptions. And so just because on January 1 of 2022 a new law is passed, that would not typically require your estate plan to be redone. So we do like to emphasize that, these documents such as a will, in my mind are a living document. And what I mean by that is you put something in place, the foundation is there, and you're going to amend it and revise it over the years as circumstances change. So the changing landscape might just be as a result of estate tax law changes, but it could also include things like, you have young children, then at some point they become adults, so do you change your will then? At some point, are you taking care of your parents, and do you need to provide for them in your wills if something happens to you? So the changing of life, of course, requires some revisions and review of documents over the years. As far as, just at least making sure those foundational documents are in place, I wanted to give you a overview of what we believe every person needs. And these would really be the basics, like, sort of setting the foundation. And that first would be either a will or a revocable living trust, which is really the document that disposes of your assets when you pass away. If a lot of your assets are, say, jointly titled with a spouse, then the titling of that property will take care of the passing of that asset at the first spouse's death. But you want to have a will or a revocable living trust that distributes the assets at the second spouse's death. So that is very important. You also need to coordinate your documents with your other assets that pass pursuant to beneficiary designations. So, for instance, life insurance is a prime example, and retirement accounts. You may have found, when you open up that retirement account, I'm sure your advisors say, okay, who would you like to have as the beneficiaries? And usually you're always going to name your spouse as the primary, but think about who that contingent beneficiary should be and make sure that you have that set up. So that's all part of the foundational process, getting a will or a revocable living trust, making sure your beneficiary designations are in order with your plan, and then financial power of attorney and medical power of attorney. So financial power of attorney is really intended to deal with a situation while you're alive where you would like someone to handle financial matters for you. If it's a durable power of attorney, which is the type we would recommend, that document is actually effective when you sign it, and we've found that for some clients it's actually been very helpful and convenient. As an example, you can name your spouse as your financial agent, and if for some reason you were traveling for business or you were just otherwise unavailable or you are suddenly disabled, your spouse can automatically jump in and handle your matters. So things that are jointly titled, your spouse would have some ability to handle regardless, but with, for instance, if you have a retirement account in your name, a life insurance policy in your name, a car in your name, your spouse would need a financial power of attorney document to be able to help manage your financial matters in that type of situation. And then the medical power of attorney, which we call here in Maryland the Advance Directive and Designation of Healthcare Agent document, really handles all the medical matters. So as long as you can express your wishes, a doctor is always going to follow your request. But should you become incapacitated, unconscious, be in an auto accident, something along those lines, this document first appoints your healthcare agent, the person who can access medical records for you, speak to the doctors, make decisions about treatment. That would be your healthcare agent. Presumably, you would name your spouse first, oftentimes, but you can also consider, who would act if your spouse wasn't able to. You have a child or a sibling or someone else that would be good for that role. And then the other part of that document is what people call the advance directive, or people think of it as the living will. And that is where you would express your wishes as far as treatment you would want to receive if you were in different medical scenarios. So Maryland has a variety of 3 different medical scenarios and a variety of treatment options, and so you could express that. The most important thing that I say when I'm thinking about, why would you do these documents, right? And there's a mindset sometimes of, well, I'm not going to be in that situation for so long from now, so why bother preparing for that? And the truth of the matter is, you're really helping your family by setting these things up for them in advance. If something were to happen to you, the last thing you want your children or your spouse to have to worry about is the logistics, right? How do I deal with this account, or who's supposed to be making medical decisions? So ideally, you have sort of set all of this out for your family. The same applies with making sure your will is up to date. Who's going to be responsible to administer the estate? Who is going to receive the tangible personal property? Are there certain items that you want to go to certain individuals? The goal of all of this is really to provide family harmony. So to set things up in a way so there aren't things to have, misunderstandings or disputes about in the future. The other side of the life insurance that we wanted to make sure we covered for you is the importance of insurance sometimes in the capacity of paying for estate taxes. So, and Tom, you were going to comment a bit on life insurance and different reasons for it.
Yes, that's right. So looking at this changing landscape, it really, as I was thinking about the different things going on with the tax law, historically as estate planning attorneys, we focus on life insurance for 2 purposes, and there are many other reasons to have them, but these were the 2 that always fell within our world of I'll say, relevance, and that is that we looked at it as an income replacement vehicle if a spouse passes away or an individual passes away and they have financial responsibilities. And secondly, and very often we would see this in second to die policies, where we have an estate tax situation or potential estate tax situation, a policy that is going to create liquidity to pay life insurance, to pay the tax, was very valuable, especially in cases where liquidity was not readily available and you were in situations where you would have to sell assets to pay an estate tax. Because when there is an estate tax, you in essence have 9 months to pay that tax, with some very specific exceptions, prior to having interest and penalties. So coming up with cash quickly is very important. That being said, life insurance has developed over the years in a lot of ways to have certain investment value for a lot of people. And I think with these changing laws, if they all do pass, the loss in step-up and basis coupled with the estate tax potential problems has really created an environment where I think it's worth, and I'm going to kind of segue into why consulting with your financial advisor regularly is so important, because they're really the quarterback for all of this. There's an opportunity potentially in the right circumstance now where life insurance, from the standpoint of what you're doing for your beneficiaries, could become incredibly valuable. And I'm going to go briefly back to this 76% Maryland or 61% federal tax situation. So in a situation where you have a taxable estate and you have life insurance or the potential to have life insurance in your estate, if it's subject to estate tax, 40% is eliminated immediately. If an asset is subject to capital gains tax, you lose another 20%. And if you have a state estate tax or an inheritance tax, then assets can be lost there also. That same insurance policy, and I'm going to use an example that's just based on kind of for instance, if, for example, you put $200,000 into $1 million life insurance policy, that's a permanent policy that definitely would pay when you passed away. Currently, life insurance proceeds are not subject to capital gains tax. So if you had $1 million death benefit and you paid $200,000 in premium, your family's getting $1 million in cash, and there is no capital gains tax element to that. So that any capital gains tax law changes do not impact you. Secondly, if you have a taxable estate and you use a life insurance trust, which is a very commonly used document that we create to hold insurance for people with taxable estates, that insurance trust actually protects the assets against estate tax. Even if you're Bill Gates and worth billions of dollars, if you have your life insurance in an insurance trust, you can avoid estate tax completely. So in essence, there may be opportunities, and this is a great conversation, I think, with your advisors, to talk about if these laws do pass, are there efficiencies that can be achieved? There already were efficiencies in some cases for life insurance as an asset, more so than just a protective measure. It may increase dramatically if these estate tax laws change, and especially if we lose the step-up in basis. Because I can see a circumstance where $1 million in assets is worth $1 million under that scenario, and only worth $240,000 if you are subject to the estate tax as well as all of the capital gains taxes. So looking at insurance in a different way, I think, could become quite attractive if these laws pass. And that really segues me quickly into the idea that when you deal with an estate planning lawyer, we're involved when we draft the documents. We're involved. We follow up every couple of years usually to make sure everything is good and nothing has changed. Your financial advisor is on the front line all day, every day, and they are constantly keeping track of these things. So from the standpoint of that relationship and having a qualified professional advisor who could identify these issues, repurpose assets when the law changes, and come up with strategies that minimize the damage caused by these taxes is really a key to the entire thing. So when we talk about flexibility for a changing landscape, we work with a number of clients who kind of are do-it-yourselfers, and they set up all their assets through the non-advisor brokerage firms and things like that. And we spend about half our time handling and administering estates and trusts when people die, as well as doing planning. And I will tell you that in our experience, having an advisor who understands this landscape and can walk the walk with a client makes all the difference in the world. There is nothing worse for a family on the back end when they're dealing with the person that answers the phone at the call station at a brokerage firm or a financial advisor or house that does not have a specific advisor for a person. And more importantly, on the planning side, there's lost opportunities, because unless you happen to be reading the right article at the right time, you don't necessarily know where there's an opportunity. So we really think in that flexibility for a changing landscape, I think advisors are going to become even, not that they're not already immeasurably valuable, but when these laws are bouncing around and investment options are bouncing around, having regular meetings with your advisor is the key to staying ahead of these things and maximizing your own benefits and minimizing the damage from these new tax law changes.
So speaking about tax law changes and the importance of advisors helping to keep things straight, could we move along to the Secure Act and retirement accounts? If you want to forward, there you go. Thank you. So there have been some tax law changes in addition to the estate tax, recent changes relating to your retirement accounts. So Tom, what's been going on there?
Well, this is an area where people have written entire books prior to the law change and will be writing new books now that the law has changed. So this is an area that we could probably talk about for hours, but I promise you I won't. I'm going to give you the highest level discussion on the change in the retirement account world and why it's important. And what Congress did at the end of 2019 and made it effective very shortly thereafter in the beginning of 2020 is they decided that the current laws were benefiting beneficiaries of retirement accounts after death more than they wanted it to. The whole purpose of creating retirement accounts, if you read kind of the history of this, was to provide security to retirees. And what was happening in the great use of these tools is people were dying with substantial retirement accounts. And what was happening under the existing law were children, grandchildren, other beneficiaries were able to draw these accounts over their lifetimes. So in essence, the stretch IRA was born, and children were inheriting IRAs and paying them out over 30 and 40 years and having a tax deferral that was just phenomenal. So Congress passed the Secure Act, and there were a lot of things in the Secure Act that were not related to retirement accounts, and this kind of flew under the radar for a while, and then it became a bigger issue. And the first thing that changed was because Congress wanted this, again, to be primarily a retirement vehicle, they tried to benefit retirees on the front end by increasing the age at which you must start taking distributions from a traditional retirement account from 70 and a half to 72. So the beginning date for required minimum distributions increased from 70 and a half to 72. Now this applies to traditional accounts, Roth IRAs where you've converted or you have them, taxes already paid on them. So for Roth IRAs, you don't really have a beginning date to take distributions, but for traditional IRAs, you now have an 18-month window that you didn't have before to start taking your distributions. So for the retiree that doesn't need that money immediately, and for people that are retiring a little bit later, waiting longer, and the longer you can defer taking your minimum distributions, the better tax deferred growth you get, and it creates a better environment for the retiree, potentially. That being said, we also go back to our original discussion of the income tax increases. For many people, especially as they age, these required minimum distributions start small and then increase dramatically. Now, the good news is the IRS does periodically update their age-based tables, which does help, but ultimately, clients and people who are, start taking their minimum distributions at 72, by the time they're in their mid-80s, those distributions become quite large for many people. And because of those large distributions, there's large taxable income. And with the reduction in itemized deductions, which may or may not come back, and standard deductions, and often when someone becomes a widower, you even lose half of that standardized deduction benefit, you can have substantial income taxes in your retirement accounts. So it's really important, again, to sit down with your advisor, I think, today, analyze the changing tax landscape, analyze the changing dates of required minimum distributions, and determine if your current structure for your retirement accounts is still what you want, whether there should be conversions to Roth, whether you should look at using the retirement account for charitable giving in the cases where that's permitted, and just kind of evaluating the long-term view and vision of your retirement accounts in light of these law changes. So all things being equal, the law changes as they impacted the pre-death world were significant but not earth-shattering. Again, that 18 months may or may not make a tremendous difference. Where there really has been a change is what happens when you die with retirement accounts. So if we can jump to the next slide, I'd like to get into that next conversation. So inherited IRAs are really where Congress decided that beneficiaries were just, doing what the law allowed but wasn't intended to do. And so generally the rule, again, I've already mentioned prior to the new law, was that if a beneficiary inherited an IRA and you name that beneficiary could take the distributions over their remaining life expectancy. And in many cases, that was 25, 30, even 40 years. And it was great because there was tax deferred growth during that entire period of time. And you took small distributions for many, many years, and it could be a real windfall. And I'll mention toward the end of this that there are still some people who can qualify for that stretch, but it's a very limited class today. What's really important, though, under these rules, and it was important under the old rules, but I think it's equally as important now, is it's very important that you have a designated beneficiary. In many cases, people forget that they open an IRA, their estate's the beneficiary, and while there are actually cases where that's not a tremendously terrible situation because there is something known as the ghost rule. If someone's over 72, you may have some ability to take it over still a fairly good period of time. The problem is if you inherit an IRA, or if you have an IRA and you leave it to your estate or to a trust that doesn't qualify as a designated beneficiary, and you have not yet reached that beginning date of 72, or if you have a Roth IRA, which technically doesn't have a beginning date, then you're limited to a 5-year payout. And that can really hurt the tax deferral. So it's very important to make sure that you review your beneficiary designations, especially if you're under the age of 72 or for a Roth, to ensure that you have a designated beneficiary. That typically means an individual or, again, a properly structured trust for beneficiaries. The general rule now is that nearly everyone, if you have a designated beneficiary, the general rule is that the IRA will pay out over a 10-year period. And the rule is that there are no required minimum distributions. There's been some debate about that, but the rule seems to be that there would be no required minimum distributions during the 10-year period after death. Your beneficiary has to withdraw the entire IRA within that 10-year period. Why that's become an issue for a lot of families is that parents, the surviving parent, very often dies when their children are in their highest earning years. So again, back to our increasing income tax rates, back to the idea that the survivor of mom and dad often will pass away when a child is in their mid-40s to late 50s, when that child is probably earning their highest income in their lives. And now let's say they inherit $500,000 or $1 million in a retirement account. It used to be that they would be able to take that in very small increments over 25 years. Now you have a 10-year window. And in that 10-year window, you have to take all that money. And it's all subject, if it's a traditional IRA and not a Roth, it's subject to income tax as you withdraw it. Not only that, but those assets also can affect everything from, the FAFSA forms and things like that. So it has an impact on your overall picture. And so in meeting with advisors and talking to advisors, what do we do now that the world has changed when we die owning these assets is important. What are the strategies that we might be able to put in place to minimize the impact on our kids if they inherit this IRA? And this is still being developed over time, but it used to be that it was such a no-brainer to simply leave your retirement account to your kids and have your children inherit it and then have those minimum distributions over their lifetime, that for many people that was kind of a set it and forget it. Name your children and don't worry about it any further. Now it really is a situation where it needs to be readdressed, and it needs to be viewed and reviewed as to what is the best plan if it's likely that you will die with substantial assets in your retirement accounts. Now, what are those exceptions to the New Secure Act general rules? Generally speaking, if a spouse is, you can still roll over to a spouse and have a spouse treat the retirement account as their own retirement account. So that still exists. If a spouse inherits an asset in a way that's not a rollover and they're more than 10 years younger than the spouse who died, they get their life expectancy. If someone is legally disabled, then they can receive the distribution over their life expectancy. If a person is chronically ill, they can receive a distribution over their life expectancy. And if a beneficiary is a minor, then they can receive a longer-term distribution until they reach the age of majority, which then impacts other things. These rules are very specific. Some of them are still being developed. The IRS has come out with some rulings and regulations, and they're still working on some final rules on these things. But if you do have a situation where, especially if you have a disabled beneficiary, if you have a child with special needs, or again, if there's a very substantial difference in the age of spouses, trusts are often used in those cases as opposed to true rollovers, second marriage situations where maybe you want to divide assets among more than just your spouse. These are all cases where really the exceptions should be looked at closely to make sure that you have the best possible structure. And again, in developing strategies to minimize those rules is important. I'm going to quickly mention one rule I think that's interesting for certain situations. I had a client where this really worked well, and that is if you're charitably inclined and you have a child or a beneficiary who you think could use an income stream for life, one strategy that's been out there, and this is great for the advisors to talk to you about, is the idea of creating what's known as a charitable remainder trust at your death in your will. You have your taxable retirement account put into that trust, and you can actually have a 5% distribution stream for that child's lifetime. The child pays income tax on the 5% every year, but because the trust is charitable and the charity gets the money when the child dies, there is no immediate income tax on the retirement account. And so in the right case, that's one example of a way to get out of the 10-year rule, benefit a child who could use that 5% income stream every year, and have a charity receive the balance of the assets and avoid having an income tax problem for a child, especially one where you think they may need income for the rest of their lives. The last thing I'll mention on these retirement accounts, again, because I could talk all day on some of this, is the Supreme Court several years ago ruled that beneficiary IRAs are not creditor protected. This was an unknown until that time, And one of the benefits of retirement accounts for you and I, people who have their own accounts, is they are generally creditor protected. If you have a liability, your retirement accounts are not attachable. Now, the distributions might be, but the accounts themselves are not. However, when you die and leave them to your children, then those retirement accounts can become taxable or can become creditor accessible, because the Supreme Court ruled that a retirement account that's an inherited account owned by an individual is subject to their creditors. So in a case where you have accounts like that, using a trust can be very valuable. And I'm going to transfer over to Sherry for a very brief discussion on, even if you don't have the taxable reasons to have trust, you don't have a $20 million estate today or even a $7 or $10 million estate in the future, why might you want to have a trust as part of your estate plan for non-tax reasons? And if we can go to the next slide, and we have about 5 minutes, and then we want to turn it over to questions. We certainly want to leave time for that. So we'll just spend about 5 minutes on this, and then we'll jump to questions and answers.
Okay, great. Thank you, Tom. So just jumping back just real quickly to Tom's example with retirement accounts and the need for testamentary trust. And I had an example, actually. This is sort of the worst case scenario. I like to use those to illustrate what can go wrong, where a child was inheriting half of her mother's retirement account when the mother passed away, and the daughter had co-signed as a personal guarantor on her husband's business debts. And the business was going through bankruptcy. So actually everything that she inherited was then used to pay off the debts of her husband's failing business. So the question is, how could we have avoided that? And for this particular client, rather than her naming her daughter as one-half beneficiary, she could have created a creditor-protected trust and had the IRA basically paid to that trust. Now, there are some special rules with trusts being beneficiaries of IRAs, but you can structure it so that you can get the creditor protection. In addition to creditor protection, there are other reasons why we recommend trusts. So these are, not focused on estate tax savings, but really just to give you some peace of mind as to how those assets will be used after your passing. I like to say, how can the inheritance be a blessing and not a burden? We've all seen the examples of unfortunate situations, whether it be a child is in a bad financial situation, they have substance abuse issues, they have mental health issues, they're just not good at keeping track of their money. That maybe if they had an inheritance, they would be influenced by someone to use that money in a way that you really didn't want it to be used. So a testamentary trust is basically, or any kind of trust, where you can outline the terms of distribution, basically the ways in which that money can be used for the beneficiary. So for instance, you can specify that, the money can only be distributed for things like health, for education, for maintenance, to buy a principal residence, to invest in a business if the trustees determine that that makes sense. But basically, it's a way for you to have some control and protect the beneficiaries. I think parents are oftentimes worried that the children are going to feel like the parents didn't trust them. Why wouldn't my parents just let me have this money? And it's helpful if you sort of spin the perspective a little bit and say, you're helping to protect the money for them. If you explain to your children the goal is to make sure that it's there for them when they really need it, that is really the benefit of setting up these kinds of trusts. It's also extremely valuable if you have any concerns, or even if you're not exactly concerned, but we all know that, divorce is not that uncommon, and if you want to make sure that any money that passes to your child actually stays with the child and your grandchildren, for instance, and doesn't end up with a spouse or a second spouse if your child passes away, and then you can specify, that money for the child is only to be used for the child and your descendants. And that way you keep it out of sort of marital property. Because what generally happens is, under Maryland law and other states I imagine are very similar, inheritances are not marital property. But what usually happens is someone will inherit the assets. They're happily married, they use that money to put an addition on the house, to buy that beach place, and put the rest of the money in the joint checking account, and then 5 years later they're getting divorced. And so a way around that would have been to make sure that the inheritance actually went into a trust for the child instead. So again, these are all, non-tax reasons, but truthfully, they're just as important, if not more important. These are the things that we have found really matter to our clients, and ways to help give you peace of mind for what may happen after you pass away. Tom, did you want to add anything to that?
Yeah, I just had two really quick things, and then we can go to questions. First of all, in the special needs world, a trust can be really valuable because, for example, Maryland and most states, if not all states, have special needs trusts. Very often they're statutory, so that the language is pretty easy actually to set up. And what it does is inheritances can really mess up public benefits for a beneficiary that has public benefits. A special needs trust, in addition to being creditor protected, can also protect assets from the government from taking it for those needs. It protects the benefits, and also if the assets come from a third party, they are not payback trusts. So in essence, those assets can go to your family after the child who has special needs, passes and no longer needs them. So in essence, they really are also known as supplemental needs trusts. So it's very valuable in that case. The other thing I wanted to mention is we kind of focused on the idea of testamentary trusts because there's a whole world of things with living trusts. One of the things people like about the idea of using trust in this sense is you don't have to deal with them or worry about them while you're alive. In most cases, these testamentary trusts are not funded until you die. So even though they're built into your documents, you're not dealing with any of the issues associated with managing and maintaining trusts. The beauty of a testamentary trust is you get all of these benefits, but until you die, they're not funded. And so you don't have to add extra work and effort to your life in trying to maintain or manage trusts. They kick in when you pass away, and that's what really makes them testamentary trusts. So that's really our presentation. I know that I saw some hand raising, and we'd love to open up the floor for questions. Okay, I see. All right, so we have Lee Phillips. Let me see if I can unmute you. Okay, go ahead, Lee.
Hi. Forgive me if this sounds naive. I'm not a professional financial person. I'm just a client. But I want to ask a quick question about the remainder tax. The charitable remainder tax goes down to 5%. What is the criterion for determining whether something's charitable? Does the person have to be disabled or underage?
No, it's actually different. I'll explain that very briefly. So what happens is, so you can create a charitable remainder trust really for anyone, any family member. And so what happens is it's known as a hybrid trust because part of it benefits your family and part of it benefits a charity. And it's a remainder trust because the charity gets the money at the end over a period of time. And the rule is that the family member or members have to get at least 5% of that money each year. So I'll use a quick example. If you had $1 million that you put into a charitable remainder trust, in year one, your child would get $50,000. That's 5%. And they would owe income tax on that $50,000. On December 31st of that first year, the account would be revalued, and 5% of the value the next year would be paid to your child. And that would continue every year that they were alive. They would get 5% of the money that was in that trust based on the December 31st date. When they later pass, then whatever's left in that trust goes to charity. And if you used an IRA to do that, because it immediately went into a charitable trust, instead of that $1 million being subject to income tax, only that 5% a year that comes out to the child is subject to income tax. And then the balance, and actually there's a second, I didn't want to get too much in the weeds, but there's a secondary benefit. You actually figure out the actuarial value of that remainder interest. And so that $1 million, if you have a taxable estate, is actually worth less than $1 million for estate tax purposes, because the charitable piece is not taxable because there's a charitable deduction against estate tax.
Okay,
so the 5% is, so that's just an annuity the child gets for the rest of their lives is 5%.
Okay, so if I understand that correctly, the bulk, the great balance, the bulk of that goes to what, a charity, a nonprofit, or?
Correct. And pretty much any 501c3, you can do it with foundations or donor advised funds. You basically choose who gets it at the end of the day.
Okay, okay.
And it has to be a qualified charity.
Okay, just a real quick follow-up, something I didn't know about the testamentary tax. That, can that be hooked into that too, to put some provisos in and like some breaks or something, or et cetera?
I'm not sure I understand the question. As far as
what's the testamentary tax?
Trust.
Is there any way?
Testamentary trust.
What's it pronounced?
Testamentary trust?
Yeah, can that be hooked into this too as like an additional layer for, to guide the beneficiary or something like that? I mean,
yes.
Hooked into the
5%. The 5% has to go to the individual. It's structured properly. You should be able to have some guardrails around how they receive it. Yes.
Okay.
Yes,
Great. Listen, thank you very much.
Absolutely.
Great presentation. Thank you.
Thank you.
Are there any other questions currently? Nope, we have two more, it looks like. Okay, it looks like we have another question. I don't know if we can, there we go. Helen, how are you?
I'm doing well. Thank you for an interesting presentation. In reference to an estate which is subject to tax and capital gains, the reason you're suggesting an insurance trust is to protect that estate from excessive taxing?
Correct. So what happens is if you died owning $1 million life insurance policy in your own name and you are at the estate tax level, then 40% of that insurance policy is really the government's a beneficiary. The United States Treasury would get $400,000 of that $1 million policy if it's owned by you, because it's considered your asset when you die. If you create an insurance trust and you put that $1 million in the insurance trust, that asset is deemed, and you have to follow some rules, but that asset is deemed not owned by you when you die, and therefore it's never subject to that estate tax. So the $1 million is basically off to the side and does not get added to your estate value for tax purposes.
Whereas if we were to liquidate some of the assets of the estate to pay the taxes, et cetera, we would be subject to a higher tax.
Well, you could almost have what's I call it a double whammy. You could have the situation where you need the cash, which lowers your estate, and if they have carryover basis, if they get rid of the step up, the assets they would sell to pay the tax could also be subject to income tax. Now, there is a deduction between the two, but it's not anywhere near dollar for dollar. So the double taxation gets a little bit protected, but in essence, yes, if you had to sell stock, for example, to pay the estate tax, and there was not a step up in basis any longer, then you would have to pay income tax also on the cash you generated to pay the estate tax. Yes, that's really the worst case scenario if these new laws pass.
Thank you very much.
Mm-hmm. Does anyone else have any questions? Eric, it looks like we have Eric with a question.
If you have what do you look at when you have a married couple, wealthy, and all of a sudden they're looking at a mortality issue, either less than a year or greater than a year? What types of things do you typically suggest, or what concerns do you start looking at for credit and transfer?
Sure.
Okay.
And I can take that question.
Great.
So, Eric, that, unfortunately, that is sometimes what gets clients, motivated with estate planning, because, as I said at the beginning, most of us expect to, have to deal with this later in life. But quite commonly, the clients who do have a bad diagnosis of some sort, they're sort of forced to face these issues. So if they do not have the foundational documents, certainly that needs to be addressed. With an illness, there may be a period of incapacity. So financial power of attorney to handle financial matters, the medical power of attorney, if they might have, an end-stage condition, they might want to express their wishes as far as, would they want a feeding tube? Would they want water artificially? Hydration? Would they want to be an organ donor? I mean, these are very difficult questions, but these are the ones that if you've thought about them in advance, you're really actually helping your family when that time arises. And then, of course, you know, making sure those beneficiary designations are in order. I mean, we've seen worse, you know, some pretty bad scenarios where people just assume that what they put on their beneficiaries 20 years ago was still the case. We actually had a situation where just the company couldn't locate the designation that had been submitted. So I would say if someone's been given a bad diagnosis, that's the right time to do an inventory of assets and check those beneficiary designations on retirement accounts and life insurance policies. And then lastly, making sure that you have a will or a revocable living trust that's going to distribute the assets in a way that's going to help the recipients and not hurt them. So if that means setting up testamentary trusts, then that would be part of that, making sure that you designate who you want to handle the estate. These are, you know, some of the tough decisions, but really important ones that you should consider if you have that type of a diagnosis.
And I would just add two quick things. In states, for example, in Maryland, where we have a state estate tax, we often will look at gifting as an option because unlike the federal exemption where you're really just lowering that exemption anyway, for example, Maryland does not have a gift tax, so often we will make substantial gifts in that case to limit the Maryland estate tax if we can use high basis assets because, again, you don't want to lose the step up in basis. And the second thing is we do look at estate efficiency in the sense that if we can minimize the probate burden, for example, a revocable trust might be an attractive tool to minimize the amount of filings and public record things that a first spouse passing might create. So we do, unfortunately, from the IRS perspective, many of the tax savings you can have, if you pass within a year, they're undone. But one of the areas in Maryland and other states that have estate tax is gifting might actually allow you to avoid at least the state side of the estate tax world. Okay, it looks like we're right up against 1 o'clock, and we don't want to keep you longer than was promised. So, Regina, I think we're probably in a good stopping point.
Yes, Tom, Sherry, thank you so much. Very interesting presentation. I hope it was helpful to everyone on the call. And if you have additional questions, reach out to your advisor and they can help you or get you connected. Thank you, everyone. Have a great day.
Thank you so much.
You too. Take care.
Bye-bye.